Residential status under income tax and FEMA law, unlocking the confusion by CA Khyati Thapa. Taxability in India is dependent on the residential status of an individual. Residential status is the starting point to determine the extent and scope of income taxable in India and the extent to which a person shall be regulated for the cross-border transactions. The purpose and manner of determining residential status of a person is different under the ITA and FEMA. ITA is a revenue law and is only concerned with taxable income and the tax thereon. On the other hand, FEMA is a regulatory law and is concerned with the permissibility of the transactions undertaken by an individual depending upon his residential status. So let's us try to unlock the confusion of the residential status as per the Income Tax Act, ITA, and the Foreign Exchange Management Act, FEMA. Residential status of individual as per Income Tax Act. As per ITA, there are three categories of residential status: resident and ordinary resident, ROR; resident and not ordinary resident, RNOR; non-resident Indian, NRI. Resident and ordinary resident, ROR, S.6, 1. Section 6 of the ITA defines residence. It is the number of days which determines the residential status. A person will be considered as a resident of India if he satisfies any of the two conditions. Exceptions. Relief has been provided in Explanation 1A to S6, 1 for an Indian citizen who is resident in India and he leaves India for the purpose of employment outside India as a member of ship crew. In such case, 60 days in second condition has been substituted by 182 days. Hence, an Indian citizen who leaves India for employment in a year and has stayed in India for less than 182 days shall be considered as non-resident. The condition of 365 days in the preceding 4 years becomes redundant in such case. Similar concession has been provided in Explanation 1B to S6, 1 for an Indian citizen or a person of Indian origin, PIO, who are outside India and comes on a visit to India. In other words, the above categorized individuals falling in the exceptions are non-resident if they stay in India for less than 182 days, i.e. they do not satisfy the first condition alone. Amendment in Explanation to Section 6, 1, White Finance Act, 2020. The Finance Act, 2020, WEFA 2021 to 2022, has amended the above exception to provide that the period of 60 days as mentioned in Condition 2 above shall be substituted with 120 days if an Indian citizen or POI has total income, other than income from foreign sources, exceeds 15 lakhs rupees during the previous year. Income from foreign sources means income which accrues or arises outside India, except income derived from a business controlled in or a profession set up in India. Derived from a business controlled in or profession set up in India. Indian income means total income earned in India plus income accrued or arisen outside India from business controlled in India or profession set up in India. E.g. Mr. A, an Indian citizen, is a chartered accountant having certificate of practice from Chartered Accountants of India. He has his setup in India and a branch outside India. He advises mostly foreign clients, and as such he is normally in his foreign branch for more than 182 days every year. He performs his back-end operations from his office in India, and during a 2021 to 2022, his stay in India is for 125 days. His income from Indian clientele is 75 lakhs rupees, while his professional fees from foreign clients is 2.25 crores rupees. Prior to the amendment, Mr. A is a non-resident, and hence his income from Indian sources of 75 lakhs rupees was subject to Indian income tax. However, post the amendment in Finance Act, 2020, Mr. A shall become resident in India since he is an Indian citizen residing in India for more than 120 days, having income from Indian sources exceeding 15 rupees. There could also be a view that his total income of rupees 3 crores is taxable in India since his profession is set up in India. He performs his back-end operations from his office in India, and assuming he has branch outside India just for conducting meetings with his foreign clients. So the onus would be on the assessee to establish as to from where were the operations done. However, it may be noted that one will have to check the DTA tiebreaker rule. Computation of Indian income of 15 rupees lakhs. There are many income which are otherwise exempt, deductible to non-resident, but are taxable in the hands of a resident individual like interest on rupee-denominated bonds, S.10, 4C, and capital gain on transfer thereof, S.47, via interest on FCNR deposits, etc. Further, by virtue of DTA, many incomes may become exempt for ANR, while a resident cannot claim the benefit under these DTA provisions. Therefore, there arises a question as to whether such nature of income, which are exempt if the individual is a NR under the Act, and whether the relief under DTA is to be considered while computing the threshold of total income of 15 rupees. In such cases, two views must be possible. Residential status should be evaluated first, so as to compute the threshold of 15 lakhs rupees. Under this view, the first step would be to evaluate the residential status. Accordingly, exemptions available to a NR should not be considered till determination of residential status. Consequently, the computation of income should be made considering the individual to be a resident so as to evaluate the applicability of 15 lakhs rupees threshold. Exemption available to NR to be considered so as to compute the threshold of 15 lakhs rupees. Under this view, exemption available to NR should be allowed by considering such individuals as NR, and accordingly any such exempt income will not be considered while computing total income for evaluating applicability of 15 lakhs rupees threshold. However, if the total income still exceeds 15 lakhs rupees, then such individual qualifies as known and accordingly, the total income shall be reworked. Introduction of new Section 6, 1 AM, Concept of Deemed Residency. The Finance Act, 2020 has further inserted new Section 6, 1 AM, which provides that an Indian citizen shall be deemed to be resident in India if his total income, other than foreign sources, exceeds 15 lakhs rupees during the previous year. However, such an individual shall be deemed to be an Indian resident only when he is not liable to tax in any country or jurisdiction by reason of his domicile or residence or any other criteria of similar nature. Nevertheless, this provision will still need to be read with Article 4 of the applicable tax treaties, Double Tax Avoidance Agreement, which may give suitable relief. Income from foreign sources shall have the same meaning as explained above. Thus, from May 2021 to 2022, an Indian citizen earning total income in excess of 15 lakhs rupees, other than from foreign sources, shall be deemed to be resident in India if he is not liable to pay tax in any country. A person shall be deemed to be of Indian origin if he, or either of his parents or any of his grandparents, was born in undivided India. Why amendment? The Memorandum to the Finance Bill 2020 clarifies the rationale by stating that high net worth individuals, who are Indian citizens and have been planning their affairs in such a manner so as to avoid paying taxes on income earned by them to any country by being non-residents of all the countries imposing income tax. Thus, the intent of the Indian government seems to be to plug this loophole to prevent Indian citizens from exploiting the residency rules of multiple jurisdictions to their advantage and to avoid tax in all countries, tax nomads. These tax nomads would plan their stay in the different countries in such manner that their number of days criteria required to be classified as resident is not met. The person in the above scenario intending to escape the residential status, so as to escape the clutches of tax norms, is what is referred to by the Memorandum to Finance Bill 2020 as a stateless person. This issue of stateless income was also raised during the discussion surrounding the foundation of the Base Erosion and Profit Shifting (BEPS) action plan and had emphasized to implement different measures to put an end to the phenomenon of stateless income. Not liable to tax. The term not liable to tax is not the same as exemption from tax or non-payment of tax or not being subjected to tax. The expression liable to tax does not necessarily imply that person should actually be liable to tax or should have paid tax. It is enough if the other contracting state has the right to tax such person, whether or not such right is exercised, and irrespective of whether such person essentially pays any tax or not. This has been considered under various judgments including M.A. Rafiq, in Re. 1995, 213 ITR 317 R. Cyril Eugene Pereira, in Re. 1999, 239 ITR 650 R. Union of India vs. Azadi Bachao Andolan, 263 ITR 706 SC. Emirates Shipping Line vs. Asset, 349 ITR 493 Delhi. Ito vs. Birla Sun Life Management Co Limited, 2010, 3taxman.com 782 Mum. Thus, based on the above paragraphs and the memorandum of the Finance Bill, one can reasonably conclude that the impact of the amendment should be only on such Indian citizens who are not liable to tax in any country by not qualifying the as resident of any country, and not on those being subject to tax under the local laws of the country like UAE. Non-resident, NR. An individual who is not a resident, ROR or RNOR, shall be a non-resident Indian. Notes: income received outside India, but subsequently remitted to India does not amount to receiving income in India. First receipt is important for consideration. While counting the period of stay, continuous stay or stay at a particular location in India is irrelevant. While computing the period of stay in India, both the days of entering in India and the day of leaving from India shall be counted in period of stay in India, conservative approach since there are many contrary judgments. Impact of the amendments: once an individual gets qualified as NOR pursuant to the amendments, he will have to go through the understated consequences. Widening of the scope of total income. Income accruing or arising outside India from a business in or profession set up in India shall now become taxable in the hands of RNOR. Benefits of exemptions lost. Various benefits available to NR will be lost on becoming RNOR. Benefits of presumptive scheme concessional rate of tax lost. Various nature of income that are taxable under concessional tax rates or are exempt in the hands of NR will now be taxable at normal slab rates in the hands of RNOR. Uncertainty in the rate of deduction of tax at source. Since the provision of residency test is based on various parameters, confusion may arise as to at what rate tax is to be deducted. S.195 for NR or other provisions applicable for resident individuals. Relief measures announced under COVID-19. With the outbreak of COVID-19 in India and the suspension of international flights on 22 March 2020 and declaration of lockdown in India and many other countries, many non-residents were forcefully bound for an extended stay in India. Hence, a relief circular was issued by CBDT on 8 May 2020, circular number 11/2020, for granting a relief corresponding to FY 2019 to 2020. In this circular, it was stated that for the computation of period of stay in India, such period shall be ignored if it pertains to inability to leave India, period between 22nd March 2020 to 31st March 2020. Departure on evacuation flight on or before 31st March 2020, period between 22nd March 2020 to date of departure. Departure before 31st March 2020 or has been stuck in India as on 31st March 2020 due to quarantine in India post 1st March 2020. Period from 1st March 2020 to the date of departure or 31st March 2020. CBDT via circular number 2/2021 dated 3rd March 2021 has concluded that since OECD, as well as most of the countries, have clarified that in view of the provisions of the domestic income tax law read with the DTAs, there does not appear a possibility of double taxation of income for PY 2020 to 2021. However, in order to understand the possible situations in which a particular taxpayer is facing double taxation due to forced stay in India, he may furnish the information in Form NR, which can be submitted electronically to the Principal Chief Commissioner of Income Tax, International Taxation. Hence, no relief measures have been announced yet for FY 2020 to 2021. Residential status of individual, as per Foreign Exchange Management Act. Residential status as per FEMA, 1999 is determined by the number of days in India in the preceding financial year, FY, and or his purpose of stay. As per S2V of FEMA, 1999, any individual shall be considered as resident under FEMA if he resides in India for more than 182 days during the course of the preceding financial year. There are two exceptions in Clause A and B, which provides that even if an individual is resident due to his presence in India for more than 182 days in the preceding year, still he be a non-resident if he satisfies conditions mentioned in any of the exceptions in the clauses. Clause A is for persons leaving India and Clause B is for persons coming to India. Clause A. Persons leaving India. If a person leaves India for any of the understated purposes, he will not be a resident in India. A. For taking up employment outside India, or B. For carrying on any business outside India, or C. For any purpose which indicates his intention of stay outside India for an uncertain period. Clause B. Persons coming to India. If a person comes to India for any of the understated purposes, he will be a resident in India. A. For taking up employment in India, or B. For carrying on any business in India, or C. For any purpose which indicates his intention of stay in India for an uncertain period. Clause B is strictly worded in the Act. There is an exception to an exception. Hence, a person will be resident in India if he comes to India for the above-mentioned purposes. Hence, a person is said to be resident in India if he has resided in India for more than 182 days during the preceding FY and A. He has gone out of India for purpose other than employment outside India, other than business or vocation outside India for a certain period, or B. He has come for employment in India for carrying business or vocation in India for an uncertain period. So, when a person comes to India for a purpose other than employment, business, or vocation for an uncertain period, he shall be a person resident outside India irrespective of the number of days his stay in India in the preceding PY. Similarly, when a person goes out of India for the purpose of employment, business, or vocation for an uncertain period, he shall be a resident outside India irrespective of the number of days of his stay in India in the preceding PY. A mere intention does not determine the residential status of the individual. When a person has come for employment or business in India, he is a resident. This is a fact and has nothing to do with intention. Intention comes into picture only when he comes to India under any other situation. But there also his intention to go back has to be supported by the facts. Hence, due to different definitions under ITA and FEMA, there could be circumstances where person can be a resident under ITA and non-resident under FEMA. Let us try to decode this with the help of an example. EG.1 Mr. A is a resident Indian who takes up a job in USA in November 2020. He was in India before November 2020. In this case, Mr. A has become non-resident under FEMA from November 2020 onwards regardless of the number of days of stay in India in FY 2019 to 2020. However, under Income Tax Act, he will still be a resident for FY 2020 to 2021 since he was in India for more than 182 days. Accordingly, his salary from Nov 20 to Mar 21 will be taxable in India subject to relief under DTA. Hence, an individual can have dual residency under FEMA but not in ITA. EG.2 Mr. A is a NRI having FCNR fixed deposits. He returns to India in Nov 20. Under FEMA, he will become a resident from Nov 20. However, under ITA, he will still be a NR in FY 20 to 21 since his stay in India in the preceding 4 PYs is less than 365 days. Under FEMA, Mr. A can continue to hold his FCNR deposits up to maturity. However, for ITA, the interest on such FCNR deposits will be taxable since he is a resident under FEMA and hence the relief of exemption US 10(4)(2) cannot be availed. Impact of NRI status under FEMA. 1. Once the residential status changes to NRI under FEMA, he must visit all his banks, brokers, and wealth managers to change his residential status from resident to non-resident. 2. A NRI cannot hold savings bank account. Hence, on change of residential status to NRI under FEMA, he will need to open a NRO, non-resident ordinary rupee, account. NRO account can be jointly held by 2 or more NRIs. Only inward remittance from outside India is possible in NRO account and are non-repatriable to another country. 3. NRI can also open NRE, non-resident external rupee account. NRE account permits money transfer services from outside India and the entire amount can be repatriated back to the country of residence of the NRI. Income earned in this account is exempt from tax. 4. NRIs are permitted to enter into financial transactions only post-approval from RBI. Conclusion. Both Income Tax Act and FEMA are important laws deciding the residential status. Hence, one should check the residential status from both taxation point of view and for every transaction to assess the requirement of RBI approvals. Disclaimer: the views opinions expressed in the articles are purely of the writer and not of Quokka.